The next section that we need to look at is cash flow estimation. Now, throughout this lecture, in all of the examples, I gave you the cash flow for years 1 to 4. You didn't have to perform those calculations. Now, obviously, guys, if this is asked in your test or your exam, you are not just going to be given the cash flows. You are going to have to determine which cash flows to include in your calculation and which to exclude. Now, please note the principles of relevant costing apply. So, in other words, we only take into account future cash flows that arise as a direct result of the investment decision. So please note there's 3 components over here to this definition. Firstly, we are only looking at future cash flows. So any money that was spent in the past is not relevant. Secondly, they must be cash flows. So depreciation is not a cash flow, it's not taken into account. Anything that's not a cash flow is ignored. And thirdly, it must arise as a direct result of the investment. Okay, so let's discuss all of this in a little bit more detail. First point I have over here is sunk costs are never relevant. Now guys, sunk costs just refer to money that has been spent in the past. So obviously that can't be relevant because it doesn't comply with the first part of our definition. It is not a future cash flow. It's money that has already been spent in the past. So if it's already been spent in the past, please don't take it into account. Then, please note opportunity costs are always relevant. An opportunity cost arises every time the company has to sacrifice something. So if by investing in a certain asset, I have to give something else up, that is an opportunity cost. So for example, if I've got 2 options available, either I can buy a machine or I can put my money in the bank account. If I put my money in a bank account, I'm going to earn interest on that money, which means if I decide to buy the machine, I have an opportunity cost. By buying the machine, I can't invest the money in a bank account, which means I'm going to forfeit or lose out on the interest that I could have earned. So by making the decision to buy a machine, my opportunity cost is the interest that I'm losing out on by not investing the money in a bank account. Then in addition to that, because we are dealing with cash flows, depreciation or any other non-cash income or expenses are obviously not relevant. So meaning if we have a machine and the company sells that machine, any profit or loss on the sale of that machine is not relevant because that is not a cash flow. Instead, what we take into account is the proceeds on the sale of the asset because that is the cash flow. We then also need to take into account the movement in net working capital as well as the recovery at the end of the period. Now, a lot of students just learn working capital as a rule and they know exactly how to deal with working capital, but they don't really understand what they're doing. So I really want to discuss working capital in a little bit more detail here so that once and for all you actually understand what you are doing with working capital. Let's start by working through the example below. So I've given you for a 3-year period what your sales are. Now please note that this is both cash and credit sales. And in addition to that, I also give you your debtors balance at the end of each year. So now logically, I want you to calculate what the actual cash flows are in each of these years. So if we start with year 1, we made sales of 200,000 Rand. However, at the end of the year, we have a debtors balance of 50,000 Rand. So that means we haven't collected 50,000 Rand from those debtors. So my cash inflow in year 1 is going to be 150,000 Rand. Then in year 2, I have an opening balance for debtors of 50,000 Rand. So that is the starting point of my calculation. I then make sales of 350,000 Rand and I have an outstanding debtors balance at the end of the year of 80,000 Rand. So those debtors have not yet paid in this year, which means my cash flow in year 2 is 320,000 Rand. Then In year 3, I'm going to have an opening debtors balance of 80,000 Rand. In addition to that, I have sales of 400,000 and my debtors balance is now 0. So that means everybody has paid me. So my cash flow in year 3 is 480,000 Rand. Now, I wanted you to look at that calculation just so that you understand the logic behind what we're doing. This should make logical sense to you. So how do we then deal with this in a question? What we do in questions, guys, is we include our total sales in our calculation, both the cash and the credit sales. So you can see that just below. I've taken the total sales for each year and I include that in my calculation. In any questions, you are going to do exactly the same thing. You include the total sales. Then what we do is we take into account the movement in working capital. And by taking the movement in working capital into account, this is going to give me my net cash flow. So you will see that these cash flows over here tie into the cash flows that are calculated above when I worked through this calculation with you logically. So what do we do in order to get these cash flows? If we have any increase in our working capital, we subtract that. And if we have any decrease in our working capital, we add that. So look at your debtors, because please remember, guys, working capital is just made up of my debtors, my inventory, and my creditors. So in this basic example, we are just talking about debtors for now. I will address inventory and creditors just now. So look at your debtors balances. At the end of year 1, we have a debtors balance of 50,000 Rand. So that means it increased from 0. I had a 0 debtors balance at the beginning of the year, and it's increased to 50,000 Rand. So what do? We subtract any increase in working capital. So I deduct 50,000 Rand in order to get my cash flow for year 1. Then in year 2, we can see our debtors balance has increased from 50,000 to 80,000. So that is an increase of 30,000 Rand. So once again, I subtract any increases in my working capital. So I subtract the 30,000 Rand. Please note, you are not working with your balances. You are working with the movement. So we look at the movement in our working capital. If my working capital increases, I subtract that movement. And if my working capital decreases, I add that movement. So let's look at year 3. In year 3, my debtors balance comes down to 0, which means it's decreased from 80,000 Rand to 0. So that is a decrease of 80,000 Rand. And if it decreases, I add that. So what is the movement? I've got a movement of 80,000 Rand, and I add that in order to get my cash flow in year 3. And then please note that our working capital levels will revert back to their original levels at the end of the investment's life. So at the end of the investment's life, we will have an opposite entry. So meaning the net effect, guys, is everything here should come back to 0. I have an outflow of 50,000, an outflow of 30,000. So that gives me an outflow of 80,000. I have an inflow of 80,000 and the net effect is 0. So my working capital levels revert back to their original levels, comes back to 0 at the end of the investment life. Now, please note, this calculation only focuses on debtors, but I told you that we are going to perform this calculation for working capital. It is not just the movement in debtors that I look at, it is my movement in working capital. So that means that this applies equally to inventory, debtors, and creditors, and therefore the movement in net working capital is used. So guys, how do I calculate my net working capital? I take my debtors, I add my inventory, and I deduct my creditors. So calculate what your net working capital is. And then what you're going to do, instead of having your debtors balance at year end, this is going to be your net working capital at year end. So we don't just look at debtors, we also consider inventory and creditors. So you take your net working capital, which is a very simple calculation, and then if my working capital increases, I subtract that. If my working capital decreases, I add that back. Now, we have already discussed the logic behind debtors. I also just quickly want to discuss the logic behind taking into account the movements in inventory and also the movements in creditors. Guys, if you look at your calculation, you're going to draw up a table for the investment life. And let's say we are looking at a 3-year investment. So we have 0, 1, 2, 3. I told you when we are looking at the investment decision, we include total sales in our calculation. So that takes both cash and credit sales into account for each of the years. Then we take our movement in debtors into account. So remember, any increase in debtors, we're going to subtract. Any decrease in debtors, we are going to add. So just take your movement in debtors into account, exactly as we did in our example in our lecture notes. And by taking the movement in debtors into account, that is then going to leave you with your cash that you collected from your sales. And why do we want this? Go back to our definition. The principles of relevant costing apply, meaning that I only include future cash flows in my calculation. So I don't want credit sales in my calculation. I want the cash that I actually collect from those debtors. We only include cash flows in our calculation. So by taking the movement in debtors into account, I'm now sitting with the cash that I've collected from our sales, and I've eliminated any portion of credit sales where I haven't yet collected that money. Then, still looking at this calculation, we are going to take cost of sales into account. So that's my cash collected from our sales. I then deduct my cost of sales. Now, please note, guys, how do we calculate cost of sales? Remember, cost of sales is just your opening inventory plus any purchases minus your closing inventory. So, I'm now going to take the movement in inventory into account. And by taking the movement in inventory into account, what am I going to now be left with? If I take the movement in inventory into account, I'm now left with my purchases. However, that leaves me with both my cash and my credit purchases. So there's one last adjustment that I still need to make. Last, we take into account our movement in creditors. And by taking the movement in creditors into account, I am then going to be left with my cash purchases. And think about this logically, guys. That's exactly what we want. We don't want cost of sales in our calculation. We don't want our cash and our credit purchases. So what we do is we include cost of sales in the calculation, but we take the movement in inventory into account so that we can get the purchases, and we take the movement in creditors into account so that we are just left with our cash purchases. Because then you have exactly what you need for your calculation. You are then only dealing with cash flows. We've included the cash that we collect from our sales, and we've also included our cash purchases. So that is the logic behind taking the movements in working capital into account. All we're doing is we are not looking at all of these movements separately. I'm not separately looking at the movements in debtors, movements in inventory, and movements in creditors. Instead, I lump this all together and I calculate my net working capital. So how do we calculate our net working capital? We take our debtors, we add our inventory, and we deduct our creditors so that we don't have to perform 3 separate calculations. We just look at the movements in our net working capital. And by taking the movements in net working capital into account, we make sure that we are left with all cash flows. We are not including any credit purchases or any credit sales. We are left with just our cash flows. So please make sure you understand the logic behind that. Then, in our investment decision, we assume that the asset is being purchased for cash. If you go back to all of the previous examples that I covered with you, we had an outflow of 100,000 Rand at the beginning of year 1, or in column 0. So we assumed that the asset was purchased for cash. The method of financing was completely ignored. So please note, guys, if they give you financing cash flows, so in other words, they tell you the interest and capital payments that need to be made on the loan, or any dividends that are going to be paid as a result of the issue of shares, that is not taken into account in the investment decision. With the investment decision, we assume that the asset is purchased for cash. So we have an outflow in column 0, or at the beginning of year 1. We never take any financing cash flows into account in our investment decision. So completely ignore any financing cash flows, because we are going to deal with those separately when we get to the financing decision. So we look at the financing decision in a separate lecture. It's a completely separate decision. This week we are looking at the investment decision. Ignore financing cash flows. And then lastly, please note that tax is always relevant. So you are going to include all of your cash flows in your table, and you then need to perform a separate tax calculation. So I always recommend performing a separate tax calculation. And when you are performing that calculation, if you have an asset that's been purchased or a machine that was purchased, you need to consider the SARS allowances in terms of writing off that machine, so the capital allowances or the wear and tear. Now, please note, normally those allowances are given to you in the question, but if it's not given in the question, please assume that the current tax legislation applies. So whatever you have in your tax act for that specific asset, please follow the same rules. It's very unlikely that that will happen because you are normally given the SARS allowances in the question. In addition to that, if you are dealing with an asset that is going to be sold after a certain period of time, you are going to need to calculate whether you have a recoupment or a scrapping allowance when that asset is sold. Please remember, if you want to calculate a recoupment or a scrapping allowance, it's a very simple calculation in management accounting. They don't integrate into the level of knowledge that you are required for tax. So for MANAC, you just need to know that the calculation is your proceeds less your tax value. And if you have a profit, you've then got a recoupment. So if your proceeds are more than your tax value, you've got a recoupment. And if your proceeds are less than your tax value, you've got a scrapping allowance. What is the tax value? The tax value is just the cost of the asset minus the allowances that you have claimed above. And then lastly, look out for taxation time lags. That just means that you don't pay the tax on this year's profits in this year. Instead, what happens is the profits for year 1 are only taxed in year 2. So what you have is your tax cash flows move back 1 year. So let me just show you a quick example over here. Let's say we're dealing with a 3-year investment once again. If it's a 3-year investment and you have a taxation time lag, you're going to have 4 years in your table. So you're going to include all of your cash flows for the 3-year period. However, when you perform your tax calculation, if there's a tax lag, it just means that the tax is paid 1 year later. So the tax on your cash flows in year 1 is paid in year 2. The tax for year 2 is paid in year 3, and the tax for year 3 is paid in year 4. So look out for that in questions. Then next we need to look at inflation. And before we discuss this, you need to know the difference between a nominal rate and a real rate. So please look just below. A nominal rate includes inflation and a real rate excludes inflation. And it's important to note with capital investment decisions, we need to always be consistent. So nominal cash flows, meaning cash flows that have been adjusted for inflation, should be discounted at a nominal rate of return. So in other words, if your cash flows are adjusted for inflation, the discount rate must also be adjusted for inflation. And in addition to that, real cash flows, or in other words, cash flows that have not been adjusted for inflation, should be discounted at a real rate of return. So if my cash flows are not adjusted for inflation, then my discount rate must also not be adjusted for inflation. Now I'm going to take you back to our lecture where we covered the weighted average cost of capital. And you will remember right at the end of that lecture, I said to you that the weighted average cost of capital is a nominal rate, meaning that the weighted average cost of capital incorporates inflation. So if we are using the target WACC as our discount rate, and we've already had a big discussion around that, we know when we are calculating the net present value, we use the target WACC as our discount rate. The target WACC has been adjusted for inflation. It is a nominal rate. So that means your cash flows must also incorporate inflation. So if there's an inflation rate of 5% over the period, those cash flows must be adjusted for inflation. The cash flows are adjusted for inflation and the rate is also adjusted for inflation. Now just below, I've given you the formula in order to convert a nominal rate into a real rate or a real rate into a nominal rate. Let's look at the example just below so that you can see how this works. So we already know that N is the nominal rate which has been adjusted for inflation. R is the real rate which does not include inflation. And please note I is just the inflation rate. So in the example below, I've told you that the real rate is 18%, so that excludes inflation. I then also tell you that the inflation rate is 6%, and you need to calculate the nominal rate. So using the formula above, we are trying to solve for the nominal rate. We don't know what that is. Our real rate is 18%. So 1 plus 18% gives me 1.18. My inflation rate is 6%. So 1 plus 6% gives me 1.06. If I multiply that out, I get 1.25. And that is 1 plus N. So I need to deduct 1 so that I'm just left with N. So I get a nominal rate of 25%. And that includes the effect of inflation. So please note, you don't just take the real rate of 18% and add 6%. So we don't say 18% plus 6% gives me a nominal rate of 24%. That is not correct. You use this formula above, which is the Fisher formula, and you solve for the nominal rate, which includes the effect of inflation. Now, please note, guys, you would never do this if you were given the weighted average cost of capital in the question, Because if they give you the WACC, you know that the WACC already takes inflation into account. So you just need to make sure that your cash flows also take inflation into account, and you're then ready to go. However, if they specifically tell you that the discount rate is a real rate, so in the question they say to you, use a discount rate of 18% and this is a real rate, and you have already adjusted all of your cash flows for inflation, you are then going to have to use this formula so that you can convert your real rate into a nominal rate. And then when you calculate your net present value, your cash flows have been adjusted for inflation and your discount rate has also been adjusted for inflation. We then need to look at how you should deal with tax losses in a question. So please note, you might be presented with a scenario where the investment creates a tax loss. Now, one of two things could either happen. Either the losses from the investment can be offset against profits made by the company's other activities, or the company does not have any other taxable profits. Now, guys, this is very unlikely. So if the question is silent, please assume that we are dealing with the first situation. So the reason why I say this, let's assume we are looking at a company and they are trying to decide whether they should buy a new machine or not. Please remember, guys, the cash flows relating to that machine are not the only cash flows that the company has. The company is going to already have profits from their existing activities. So that's what I'm talking about in the first bullet. This actual machine is going to create a tax loss. However, the loss can be offset against profits made by the company's other activities. Because it is very unlikely that you are going to be dealing with a situation where a company does not have any other taxable profits, meaning that the only tax that they're going to pay is the tax relating to this investment decision, and they don't have any other profits in their business. So what were they then doing before they decided to buy this new asset? So that's why I'm saying this is very unlikely. Normally, you're going to be dealing with an existing company that has existing profits, existing cash flows, existing tax that they pay across to SARS, and they are now just considering the purchase of a new asset. So if that is the case, guys, if the company has profits from their other business activities, then you are allowed to recognize a tax asset or an inflow. So what I mean, you can see here that we are sitting with a tax loss because my wear and tear is greater than my taxable income. So I'm sitting with a tax loss. Now remember how it works. If you have a tax loss, SARS doesn't actually refund you that money. So you can't actually show that as an inflow. However, if the company has profits from their other business activities, all they're going to do when they do their tax return, they will obviously include all of the income and expenses from their other activities, and this will then just reduce the tax that they need to pay. So this is a tax asset or a tax inflow or a saving, because the company will use this in order to reduce the tax that they need to pay across to SARS on their other activities. So what are you going to do in your calculation? You are going to show this as an inflow. So if the company has a tax loss, like we have in this example for the first 2 years, we show this as an inflow. Then the company has taxable income in the last 2 years, and they will then be taxed on that. So that is obviously an outflow. If you look at the next scenario, so this is where the company does not have any other taxable profits. So remember, I said to you, even if you have a tax loss, SARS is not going to refund you. So if the company doesn't have any taxable profits that they can offset this benefit against, then you are not going to have any tax cash flows in those years. Instead, what you do is you carry this tax benefit forward until the company has enough profits that can be taxed. And in the final year, you can see instead of sitting with a tax loss, they are now finally sitting with taxable income. SARS will then tax them on that at a rate of 28%, and they will pay tax only in year 4. So if the company does not have any other taxable profits, in the years where you have a tax loss, you do not recognize that benefit. You just don't have any tax in those years. You carry the benefit forward. You offset it against your future profits so that you can reduce your tax in future years. And then you recognize the tax payments in the year where you actually have taxable income. On the other hand, if the company does have profits from their other business activities, you can then recognize the tax benefit in the years where you have a tax loss, because all that's going to happen is they are going to offset this benefit against their other taxable profits. So they are not actually getting a refund from SARS. Instead, they are going to use this tax benefit to reduce the tax that they need to pay on their other profits.